It is so good to be back with you for another week of the Lone Star Capital podcast with the CEO and founder, two-time author, Rob Beardsley. Your host, Craig McGrouther, the Director of Business Development, coming at you with enthusiasm unknown to mankind, as Jim Harbaugh would call it, fresh off a golf trip, hence the Abandoned Dunes hat. I was playing lights out. I may have shot under par for the first time, and I may have knocked in a ball from 80 yards away for a hole-in-one.
Hole-in-one.
But does it count? Does it count? I don't know. I don't know if it counts. I don't know if it does or doesn't. I really don't know. Does an 80-yard shot on a par 3 course count as a hole-in-one? If it does, to you, leave a comment below on this show.
I think it does, because I don't think the difference between an 80-yard hole out versus like a 120-yard hole out's that big of a deal.
Does it count? I have a plaque. I knocked it in. So what had happened was, it was the last round. We played all courses at Abandoned Dunes, golf mecca. You should try it. And if you're a golfer, very reasonable for what you're getting to, by the way, out there, might I add. And I knocked in a ball from 80 yards. But we're not going to steal the show today to talk about that. If you do think it is a hole-in-one, let me know. It is a stroke-in-one, so it does count technically. It would be better if it was on a different course, but it was cool. It was the last shot of the trip. I digress. We got a lot to talk about today. Lots of people have been calling me about you recently, funny enough. I've gotten about 5 to 10 phone calls. I'm not going to dox you. I'm not going to talk about your life out there. You can talk about it later if you'd like. However, beautiful things happening with two of my incredible friends. It's so fun to see it. So let's just say there could be growing people to the family. No kids, but growing people to the family. That said, a little housekeeping here. We are on a roll with deals right now. We have less deals than we have equity for. So we have, let me rephrase that. We've got not enough deals for the amount of equity we have kind of in the staples there. So we've got a lot of people that have been calling me, riding off the momentum of our trip or our conference. Our capital stacks are getting full. We just sent one out to some of our, kind of capital partners there, if you will, that are looking to raise for our deals. Kind of just send it out as kind of a feeler thing. And we've almost filled up the whole capital stack with about 10 phone calls from me on a Monday. Love to be in those situations and places. But that said, I can't harp this enough. Be the squeaky wheel and get into my inbox. Call me, text me, do whatever you got to do. But, I can only help those who help themselves. And our partners are relentless trying to get in it. They're literally booking flights to come out to where the next site is already before we even gave them allocation of the deal, asserting themselves right in the middle of our operations. And I just love it. I love that. That's the enthusiasm
I was on the phone with a partner last week, and I was saying, the new deal, I'm not sure if it's going to be really available to you. So, I already got my flights booked. I'm going to come for due diligence.
Sorry about that. It's full. No, but on that note, our deals really are filling quickly. We had about $1 million of our own internal investor capital for our last deal that we just closed, as we mentioned on the show last week, Cortland Med Center, that did not make its way into the capital stack, unfortunately. So it really sucks when that happens. But, this is kind of a note to adhere to the funding deadline. And actually, guess what? Fund quickly, because there's no penalty to you to not, because our preferred return starts the day that you fund. So you fund then, your clock ticks then. So threading the needle is not the smart way to do it.
Sorry, I'm the one interrupting you today. But if you are an investor and you invest in other deals, other sponsors, you probably want to ask, how is my capital treated upon funding? Does my preferred return begin to accrue upon funding date or upon closing date? We used to actually accrue the preferred return upon closing, but we switched over to the upon funding date because it's just a more fair way. Why would we penalize people who fund later, right? We want people to fund early and on time. So why don't we incentivize that and actually appreciate them for that by having their pref clock start then rather than later, so that they don't have dead equity?
Yeah. So just to kind of tie a bow to this conversation, in all seriousness, our deals are filling up quickly. I wish we had a couple more deals like this that we're kind of doing right now, what we have kind of in our back pocket and what we've done previously. So with that said, please reach out to me if you're a capital allocator or a investor looking to find the next opportunity. If you've got a 1031 exchange, if you have anything of that nature you want to discuss with me, run by things with me, let us know. So please help me, help you, help yourself. be a squeaky wheel. Let me know what you're doing, what your capability is. We've had a lot of people do that recently, and you just make yourself available. Good things will happen to yourself. You have to ask for things in life. So please, if you are interested, final note, let me know on that. So that's a little housekeeping there. Another thing I want to discuss just very briefly is what events we are doing next. Unfortunately, I will not be going to Raise Masters Retreat in San Diego. I'm a little bit traveled out, unfortunately. I've done about 10 conferences this year. I have 2 more left, and then I'm done. Well, 3 more events left, if you will, because we have our event coming up in Menlo Park, California, around the holidays. So if you're a Bay Area person, hopefully you can come. Email
Or if
me,
you're
of
a Southern
course.
California person, fly up,
Yeah,
fly up. It's going to be a great event.
fly up and pull up. If you like to wine and dine with your favorite people with Lone Star Capital, we will be there in style, in fashion, at an incredible venue, like always. So that's exciting there. And then I'll be going to 2 events I want to shout out right now. Ascent, which is a very institutional level event. It's a Biz Now event. I did Elevate a year ago. It was awesome. I have some incredible contacts that I'm in contact with today. We're sharing deal flow with. We're close with some of those people. Haven't converted them yet, but this is the level up as I have leveled up within the firm. So it's very exciting that we've got the Ascent Now Biz Now event in Miami. So if you're in Miami and you want to meet up, we'll be there, I think, around November 2nd to the 6th.
To the 3rd, to the 5th?
No. I think it's the 6th.
Yeah, to the 6th, to the 6th.
See, there you go.
Yeah,
so
no.
November
You're going to
2nd.
be busy. You're going to be busy for sure with Ascent, but still, we've got quite a few investors and partners in the local Miami area, so we would love to organize, and we will be organizing a dinner of sorts.
Dinner
over
and
that
lunch.
time.
Yeah, we want to be, kissing babies and shaking hands or shaking hands and kissing babies, as they say. So we want to, of course, get up and close and personal with all of our friends and people out there. So please let us know if you're there. And then, of course, want to shout out our very good friend to the show, to this company, and personally, Sam Silverman is throwing his first event. Good for him. The fully funded event, his baby here. Very excited. It'll be my first time in Tampa Bay. Certainly not yours. And we will have a good time there. So we'll be doing a little SoFlo trip. Excited for that. Get some good weather. Don't want to be in Tampa or Miami in the summer, but in November, it's prime time to be there. So I'm absolutely pumped on that. Is there anything else I've missed on that you want to shout out and touch on, other than maybe just teasing our events coming up at the end of December in the Bay Area?
Yeah, we're going to have a great. We usually brand this event as a holiday party because obviously it's in December, but it's more than just this year. It's going to be more than just simply a party or a holiday event. It's going to be kind of like a mini summit almost, or at least I envision it to be. We'll see if we can pull it off, but I want it to be with a bit more programming. So having some discussions, some presentations, some panels, hear from different people from Lone Star, talk about the year, talk about 2025 coming up ahead, and make it a little bit more of an informational thing for people to attend to, not just show up like, hey, I'm going to mingle and maybe bump into somebody and have a good conversation. We want people to more concretely get some value out of this event and make it a little bit more of a Lone Star show. So that's how we're evolving our events to be. And that's why, like I said, I think it's worthwhile for some of our investors and partners who are eager to actually travel, and not just if you're in the Bay Area, but actually travel out. If you're in, a short flight or a short drive away, it would make sense to attend.
Yeah, and we really, as we've alluded to time and time again over the course of this year on this podcast, it is a big mission for us to meet everyone in person. Of course, you can do phone calls, Zooms, texts, but there's no substitute for, solidifying that relationship, meeting in person, and forging it in that medium. So we'll be hosting that. Be on the lookout for that. And then I just want to briefly touch on 2024 deal flow, what we have and what's to come and beyond. So we may or may not have an opportunity, as I said, to start the show. So reach out to me if you're looking more for that. But just as you think, because this is a question I'm getting often, is what's your pipeline like? What's going on with the rate cut, with kind of the market changing, with kind of some good tipping points, with good data points out there for this being a good time for a lot of people who maybe been burnt or sitting on the sideline for the fundamentals to change. Rob, in your world, what does our pipeline hold for where we're at today? And I guess let's just call it for 2025 first half of the year, just because we can't forecast what's going to beyond that, if you will, with how quickly the world changes.
Yeah, I think the first half of 2025, we're going to continue to be focused on our niche strategies, niche affordable housing strategies that primarily keep us in Houston. And I think that's a great place to be right now. Oil is doing very well. Houston itself is doing very well. It's actually the least challenged market in all of Texas when it comes to supply. So I think Houston, while it was a good market, but not the best market in the up cycle, I think now in this new cycle, it's poised actually to be the best performer of the Texas major markets. Couple that with the amazing strategies and relationships that we've developed there, I think it really is the best place for us. The only downside, of course, is diversification. We and our investors would prefer to have deals not just in Houston, but get a little flavor of San Antonio and Dallas and eventually Austin. So diversification is very valuable, but we really have to focus on where we think we can drive the best outcomes. And right now, that's our affordable housing strategies in Houston. So I think that's what our first half of 2025 is going to entail.
For sure. Awesome. Well, let's get right into the meat and potatoes of this show. You wanted to talk about something, I think you texted me when I was at Bandon playing, was prepayment penalties. You wanted to talk about that. So let's kind of harp on what you had brewing mentally there and get into a conversation on that.
Yeah, so prepayment penalties are something that some people talk about, but then they totally forget. And also, it's something that pretty much nobody really underwrites. If you look at someone's underwriting for a deal, they almost always completely ignore the prepayment penalty in their underwriting analysis. So whether that be, and that's really for perm deals, because if you're buying a deal on a bridge loan, then you typically have a 1% exit fee, or it's a waived exit fee if you refi with them, et cetera. So if you have a 1% exit fee, okay, you just put that financing fee into your model. That's easy to account for. But what I'm talking about is longer term debt where you might have defeasance, yield maintenance, and things of that nature. People really, when it comes to yield maintenance, people kind of just turn their brains off and just say, well, that's something for us to kick the can down on and not think about. But the reality is yield maintenance is what you need to think about the most because it's the most pernicious, most costly form of prepayment penalty. Furthermore, yield maintenance is a calculation. So it's not just a fixed penalty of, oh, I have to pay 3, 4, 5% of the loan amount as a prepayment penalty, right? So yield maintenance is a calculation which your prepayment penalty is correlated to the to prevailing interest rates when you go to prepay as compared to the interest rate that you locked at. And the thing about today's environment is we have already seen rates come down quite nicely, which everyone's excited about, and that's starting to thaw the market and people are getting slowly back to business here. But in my opinion, there's still more room for rates to continue to come down on the long end of the curve. And what that means is right now, if you're doing a fixed rate loan for a 5-year, 7-year, 10-year term, you are potentially locking in a rate that is going to be higher than where treasuries are going to be. Treasuries are likely to be down a year, 2 years, 3 years, 5 years from now. Well, I don't know about 5, right? But we're at potentially like a medium high point in treasuries. So the thing is if you're going to have a yield maintenance prepayment penalty and prepay at a time when rates are lower than when you had originally originated the loan, your yield maintenance is going to go up. Whereas it's the opposite. Like back in 2020, when people were locking in long-term debt and they were geniuses for doing so because you were getting 3% money for 10 years, they didn't worry about the prepayment penalty at all because in their head, they're thinking, well, interest rates are likely to be up in the future, which is actually going to make our prepayment penalty cheaper because that's how the yield maintenance calculation works. And also, if we're locking in a 3% rate, we can potentially have the buyer assume that loan, which means we don't have to pay any exit penalty whatsoever. So those are just like, honestly, that was a lot of talk there, but that's like the starting 1% of analysis when it comes to prepayment penalties. Prepayment penalties are so complex and you have to tailor it so much to your individual business plan because when you look at fixed rates, floating rates, you might look at two rates side by side and you can say, well, I look at the forward curve and I look at the cost of floating, I look at the cost of fixed and everything, and you can average it out. But what people don't look beneath the surface on is, well, what is that fixed rate loan costing you if you factor in the cost of the prepayment penalty, right? Because losing flexibility costs you something. So even though you're getting a lower interest rate, let's say, you're actually in the end potentially paying more by restricting yourself or selling for a lower price because you've got a bad loan in place and you have to assume it, or you have to pay a nasty prepayment penalty. So these are the things that Brad and I spend a lot of time thinking about as we're putting together our deals and thinking about, okay, do we take 5-year debt here? Do we take 7-year money? And so on.
So a lot to unpack there, and totally, I think you said the correct words there, which is the tip of the iceberg. So my kind of question asking wheels are spinning here. So I guess just to start, what is defeasance? Because yield maintenance, defeasance, can you kind of cover that real quick? Because I think people throw these words around. They're kind of almost not to say buzzwords, but they're just industry jargon where you say, oh, we've got this defeasance. Oh, don't worry, have this, have that. But can you just talk about what defeasance means in relation to yield maintenance?
Yeah, so we'll take a step back and we'll start with yield maintenance. So yield maintenance is a prepayment penalty with a calculation methodology that takes a look at your interest rate that you originated the loan at. So let's say today interest rates at the treasury, like 10-year treasury or 5-year treasury, is 3.5%. And so that's your loans being originated when the treasuries are 3.5%. And then let's say you prepay at another time when rates are, let's keep it simple and say 3.5%. So yield maintenance basically obligates the borrower to pay all of the remaining interest due on the loan, net of changes in the rates. So if the rates are the same from when you prepay to originate, then it's basically like, hey, if you're going to prepay a year early, 2 years early, you're basically on the hook for paying that interest cost for the rest of the 2 years. So you're on the hook for that interest almost no matter what. And then what happens is if rates are higher at the time of prepayment, then it actually benefits you because the lender is more happy for you to prepay because they're in a higher interest rate environment now. So if you prepay them early, they can take that money and make a new loan and make more money, right? So they're more happy. But let's say someone originates a loan at 6%, and then now we're in an environment where rates are 3%. That lender's going to be pissed if you pay them off, right? So yield maintenance protects. It's call protection. It protects lenders against that because the prepayment penalty is going to be high. The yield maintenance is going to be higher to account for the fact that we're now in a lower interest rate environment. And so it's some fancy, complicated calculation to make the lender whole. Now, defeasance takes this concept and bolts on another layer to it, which is you actually aren't just paying the lender a prepayment penalty. What you're doing is you're buying financial instruments that are going to pay out the same as if the lender would to have kept, or as if you were to have kept the loan in place. So what I mean by that is, let's say, you lent me $10 million at 5%. You're collecting 5% on 10 million every year, right? So you're collecting 500K every year. And let's say there's 2 years left on the loan, 2 years left of defeasance. I wouldn't just be prepaying you $1 million and say, hey, here's 2 years of interest, here's $1 million, I'm paying you off. I would actually have to buy bonds that would pay you that 50K or that 500K per year for the next 2 years. So I'd have to buy financial instruments. So the reason why defeasance is even worse than yield maintenance is because you have to go through the headache and added transaction costs associated with buying a financial instrument to be able to facilitate the ongoing payments to pay out the remaining obligation to your lender.
So what I also find to be interesting is when you are doing deals like what we're doing right now, and if you think debt is going to go down, a lot of people, oh, well, can you just refinance? Oh, you'll just refinance in a couple of years, right? No, because it's very expensive. And on top of that, if we sold it in 4 years and debt were low, it's like, okay, great. Well, surely there's less prepayment penalty, right? No, that's actually not the case. The lower rates go, the more expensive that early prepayment could be. Of course, you hope that you're selling early because rates have gone down and the value is obviously higher. Perhaps you've, outkicked your coverage. You have outperformed your projections. The market is humming. And, you never go wrong by selling in the black, if you will. But there's a lot more nuance to that. Can you maybe touch on that just a touch deeper regarding, because rates going down and the cost going up to exit on fixed rate debt?
Yeah. And you brought up a good point that how everything is interrelated, meaning if rates are lower, ostensibly cap rates are lower, which means your property is now worth more. So it's an exciting thing because you could potentially sell for more because rates are lower, caps are lower. But if you have a fixed rate loan with yield maintenance, then your prepayment penalty is higher, right? Because like I was explaining how when rates are lower than when you had originally locked, a lender wants to have that protection. So you actually owe them a bigger prepayment penalty because you're penalizing the lender by prepaying the loan into a lower interest rate environment where they're now going to have to go and relend that money out at a lower rate. So things are all connected, right? You might be able to sell for a higher price because of lower rates, but you will incur a higher prepayment penalty because of lower rates as well. And this is a similar topic that Brad and I were actually just having a conversation about, which is the conversation of refi versus sale. And the funny thing about that sort of analysis, like, oh, is it a better time to refi or is it a better time to sell right now? And the reality is those two things almost move together in lockstep. There are times where there are disparities, but it's at a very high level in general. If it's a better time to sell, it's also a better time to refi, right? Because if rates are lower and caps are lower, that means you could sell for a higher price, but you could also refi at a better valuation and probably get more cash out, and you're refining at a lower rate. So they're also interrelated. So you kind of have to look beyond those analyses and understand your personal business plan, understand tax implications, understand your reinvestment risk, understand the capital markets environment, because there are certain deals or certain situations where you maybe can't refi into a super attractive loan for some sort of idiosyncratic reason, but you could sell and get a better price than you could refi and things like that. And I think prepayment penalties have a lot to do with those analyses, like you said.
So, is there any other kind of weird, I'm not going to say fugazi, but nuances associated with debt prepayments that the average person, even as who's an investor or, the more sophisticated person may actually not know, but you'd want to share with them pertaining to the subject that maybe you learned along the way from kind of signing on these deals and such?
Well, something that actually just popped into my mind, we talked about this before, but it's just like a little tiny snippet. But Freddie Mac actually, the way that those loans are structured is with defeasance. However, what a lot of people don't know is you can actually pay a little bit more on the interest rate in order to get it switched from defeasance to yield maintenance, which is super valuable, especially in a falling rate environment. So all of the deals we've been doing with Freddie have been yield maintenance deals. So that's number one. That's like just a nice, easy win, and that's really valuable. Other than that, I would just go back to my original point that out of the hundreds of models that I've seen from other sponsors and everybody buying deals, I don't think I've ever seen anyone actually underwrite a yield maintenance into their deal. And I'm talking about people who are underwriting a 5-year hold and they're slapping 10-year debt onto the deal. And so they're assuming they're going to sell in 5 years' time, and there's going to be 5 years left remaining on the loan. And generally speaking, especially when you're talking about agency debt, 10-year loan terms are coupled with 9.5 years of yield maintenance. And then the final 6 months of the loan are open at par. So you could pay with no prepayment penalty in the last 6 months of the loan. But if you're going to exit the deal in 5 years' time, you still have 4.5 years of yield maintenance remaining under the loan. That's a lot. That's a big prepayment penalty. Depending on where rates are, that could be 5%. It could be, I don't know, even 10% of the loan amount as a prepayment penalty effectively. So that's something that you want to be aware of and make sure that things are all aligned. Like something that I think is very elegant and makes a lot of sense for our strategy and for our investors is we're underwriting 5-year holds because we typically want to be an opportunistic buyer and seller and owning for about 3 to 5 years. And we've been coupling that often with 5-year debt. So when you do agency debt with 5-year terms, the yield maintenance is typically 4.5 years, again, with the final 6 months open at par. So what does that mean? That means that if we were to sell after 3 years, we would have a year and a half or 18 months worth of yield maintenance to contend with, which is still not nothing, but it's reasonable, and it's something that we could still make money with. So, and if we hold for 5 years exactly, like we had underwritten, then we would have zero prepayment penalty, and that's a beautiful thing, right? And that means we could at that point refi with no penalty or sell with no penalty, and that's what our investors are looking for, right? They're looking for a capital event within, I would say, 3 to 5 years. One last point I would say, the fugazi, or just the thing to keep in mind, is that the prepayment penalty on your fixed rate loan is not set in stone. There's a lot of ways to customize your debt. You can customize it by, like I said, you could go from defeasance to yield maintenance. That's possible. You could also buy down your yield maintenance. You could do, for example, a 5-year loan term, but instead of doing 4.5 years of yield maintenance, you could do 3 years of yield maintenance. And then you could sell after 3 years with no penalty. So you have to do the cost benefit analysis of, okay, well, if I pay a higher interest rate every year in exchange for a more flexible prepayment penalty, in the end, am I going to make more money, right? And that would be a perfect example of valuing IRR higher than cash flow, right? Because if you're going to pay a higher interest rate, your cash flow is going to suffer. But if you're going to retain flexibility and potentially exit for a lesser or no prepayment penalty in a shorter amount of time or the same amount of time, your IRR is going to go up. So you have to ask yourself, what's more valuable to you, IRR or cash flow? And I think that's just a very individual question. And also, in the world that we're in, where we are a fiduciary and we're investing on behalf of our investors, we have to listen to them and figure out what do they want, and then tailor the deal to that.
Well, that'll segue into, in a little bit, a kind of theme and topic that I wanted to mention. For some of the feedback we had for a deal recently, we sent out some of the bigger fish, bigger check writers, if you will, more institutional shops that are putting out fit 5 to 15 million to up to $50 million checks for deals. So we'll kind of dive into that a little bit later in the discussion here today. But just want to talk through some prepayment penalties for certain kind of loan products. So, and just for clarity too, you mentioned this, but I want to reharp on this for those who maybe not as privy and familiar with our kind of deal profile and setup just at a holistic level. You mentioned this, but we're kind of projecting a lot of our deals, typically speaking, to be around 7-year holds. And with that said, I would say that, we're taking about either 5 or 7-year debt terms right now with fixed rate debt. If we're doing a 7-year term, it'll likely have a 5-year yield maintenance on that opportunity, probably a little bit more interest only in that loan period, maybe 2 or 3 years, for sure 2 years right now in this environment, with maybe a slightly better rate right now. The 7 years looking a little bit better than the 5-year treasury. So
No,
there are other little 7
opposite.
years.
7 years.
Okay.
7 years, like 10 bips higher. Actually, as a
Okay.
matter of fact,
We'll pull it
I'll
up
give
right
you the
now. Fact check me. But
I'll give you the up to date.
yeah, it's a little bit. It's in that region and close enough, or it's
Yeah, it's eight
not
nine
not a.
bips right now.
Okay, gotcha. So it's a slightly different there, but I think a lot of people think about their downside protection, particularly in this market. So I think 7 years is interesting because naturally a deal is de-risked by the debt profile associated with it and the length of time you get on that deal before a capital event needs to happen from term ending or effectively something else of that nature. So just something to think about there. We're typically taking out 5 and 7-year fixed rate debt terms, and debt's been kind of landing between 5.4% to about 6% on the deals we've done so far to this point in the year. But it seems like we're going to get debt sub 5.5%, maybe dare I say 4.8%, just depending on the lender spread associated with the deal. Rob, can you just talk about real briefly while we're on that subject and just glaze over the subject just for a quick second, which is how lender spreads work and what that means? We did have one of our partners who had a question about this at one point, which is lender spread and how our interest rate is comprised. So you'll have the 2 to 10-year treasury note, right? Or amount depending on the day, and then you have a lender spread. So you add those two factors together. But can you explain in a Rob Beardsley fashion way how that is comprised?
Yeah, so your borrowing rate or your all-in interest rate is comprised of two factors. You have your index rate, which is the index rate. I'll explain that in a second. And then you have your lender spread. So the index rate is going to depend on the loan product and the loan term. So if I'm borrowing a 5-year fixed rate loan, my index rate will often be the 5-year US Treasury yield. And if I'm borrowing a 7-year loan, then I would have an index rate of a 7-year US Treasury yield. And so lenders don't set the index rate, right? That's the index. That's where the world is. So the whole world is borrowing off of these index rates. That could be SOFR, that could be treasuries. And so if you're upset because rates are higher, it's not often your lender's fault. Like the lender didn't set those higher rates. It's the world, it's the economy setting those rates. But the lender does, however, set the spread. And that is their profit essentially above and beyond the index rate, because the way that a lender works is a lender also is borrowing money in one form or another, whether they're borrowing through bond issuance or they're borrowing through like sub debt or like synthetic AB notes, mezz finance, like all these different things that can comprise lender financing, like note on note financing or even things like that. So, so a lender has borrowing costs as well, ostensibly that is roughly in line with their index, with the loan's index rate plus a smaller spread than the spread they're charging, right? Because everything in finance is just a spread business. You're borrowing at this and you're lending at that. And so lenders want to make money, and so they have a spread. And so that spread is going to be reflective of the risk of the deal and how competitive the lender is chasing that deal. So obviously bridge loans are riskier than fixed rate loans that are permanent. So a bridge loan is going to have a higher lender spread than a permanent loan. So that's a big distinction when it comes to bridge versus perm loans, is a higher spread. The lender wants to be compensated for the risk of a bridge loan because they're lending you money on pro forma. They're not lending you based on in-place performance, and they're often giving you more leverage and so on. So I think it's important for people to realize when they're thinking about borrowing bridge debt today is right now we have a deeply inverted yield curve when you compare treasuries versus SOFR. And bridge loans are based on SOFR because SOFR is a monthly resetting floating rate index. So every month, wherever SOFR resets to, that's where your loan is going to be charging you the interest on. So SOFR right now is about 5%. And the lender spread is going to be potentially double or more than what the perm spread is. So you're talking about 8-9% interest rates today on bridge loans, and that's a function of a higher index rate and a higher lender spread. Whereas today we're borrowing, as an example, 5-year money. So the index rate is the 5-year U.S. Treasury yield, which is today, this very second, is 3.51%, so 351 basis points. And then lender spreads are in kind of the mid to high 100s, call it like 170, right? So that puts us at basically 5.2% for all-in rates. So that's kind of the delta right now between index spreads, all-in rates in the market today.
Very good. Thank you for that. So let's talk about prepayments now, moving the conversation back there to floating and then bridge, because of course we just mentioned and into great length on fixed. So floating rate debt, what is prepayment looking like there? And then bridge, if we could talk about that too. And maybe it doesn't even include some of these items, right? Just due to the structuring of the debt itself.
So the beautiful thing about floating rate debt is because you're floating and your interest rate changes every month based on where the market is, a lender's not worried about you prepaying the debt because the debt's already adjusting to the market environment. So it's kind of like the lender is taking interest rate risk just as much as the borrower is taking interest rate risk on a floating rate loan, right? We think about it, a lot of us listening here, and we think about floating rate risk from the borrower standpoint, right? I borrowed a loan and it was originally 3%. Now the rate's 7%. My deal's not going well. This is horrible, right? That's called interest rate risk. And that's why a lot of people don't like to float, because it's more volatile experience. Well, lenders experience the same exact thing, right? Because if a lender made a loan and it was at 7% and now it's floated all the way down to 3%, right? The lender could be pissed, right? Or even worse for a lender, if they made a fixed rate loan at 3% and then now the market's up to 7% and they're just stuck with all this money out at 3% when they could have been invested that money in a floating rate loan that would have floated up and they would have done better. So it's when a lender makes a fixed rate loan, they're taking interest rate risk. When a borrower takes a floating rate loan, they're the ones taking interest rate risk. So that's something important to note. The reason why I say all that is because a lender is happy, sanguine, whatever you want to say about a floating rate loan, they don't mind the prepayment penalty. Or they don't mind you prepaying. So the prepayment penalty is only typically 1% of the loan amount. It's kind of just like your standard fee just to handle the transaction and exit the loan. And that's typically the same for bridge loans, because bridge loans are shorter term loans in nature anyway. So they don't necessarily want to penalize you from prepaying anyway. And most bridge loans are floating rate. So again, they're also happy for you to prepay as well.
Got it. And then let's talk about bridge. So bridge, usually it's shorter term inherently, maybe a 2 year, a 3 year with a 1+1 add on to it. But can you maybe mention kind of the structure there? Because we actually closed one deal on a bridge here this year, kind of unexpectedly so, but of course seems to be a wise decision, of course. Thank you to our friend Nate Lowy with Juniper Capital Group for the advising on that. I have a runaway mic here. Nate Lowy for our amazing advice there. And if you're not using Nate and you're a sponsor, you should. Unfortunately, I wish I didn't have to give him that plug, but he's just too great. And of course, our platinum sponsor, so we owe it to him. But he is the best, the brightest, and who we use. Like Rogers Gray, we want to work with the best. So with that said, Nate Lowy, your guy for debt. Okay, there's his free ad for the day. But that said, let's talk about bridge. We did one. Why did we do that one? And what are the prepayment, obligations or strings attached to that debt profile?
Yeah, much in the same way why you would want to borrow floating rate debt. It's kind of the same argument for bridge, right? Because both of them afford you prepayment flexibility. So if you want the flexibility because you think you're going to do a refi or you think you're going to have a sale in like 3 years or less, then you really should be thinking about a bridge loan because you're going to, or floating, because you're going to be able to exit, like I said, for a 1% prepayment penalty. And then a bridge loan is also valuable because you're able to get max proceeds as compared to a debt service coverage ratio constrained loan like a Fannie Mae loan, even if it's floating, right? So, and the thing that's really tough about agency floaters today as opposed to years past is the agencies have changed their guidelines on how they size floating rate loans. So what they used to do is they used to look at the DSCR and they would calculate the DSCR based on the fixed rate equivalent, right? So they would look at, okay, well, let's say you were doing an agency loan that was fixed. The rate would be 5.5%. So then they would calculate the DSCR based on a 5.5% rate, and that's how they would size the loan proceeds for the deal. But in today's environment, SOFR's 5%, the spread's going to be like 200. So you're talking about borrowing your starting rate at 7%. So the agencies are taking a more conservative approach now. And instead of doing the fixed rate equivalent of 5.5% for your DSCR calculation, they're using 7% for the DSCR calculation, which of course is going to hurt your numbers and it's going to limit the amount of proceeds that the lender is going to be able to offer you on the deal, assuming that you're DSCR constrained and not LTV constrained, which 99% of deals in this environment and in many environments moving forward, in my opinion, are going to be DSCR constrained and not LTV constrained. So it's kind of like a double whammy. You get hit like, okay, I have to eat a crappier interest rate today and I don't get as much loan proceeds as I want. So it can kind of really get in the way of your business plan. And that's where bridge loans can come into play. You'll pay maybe 125, 150 basis points more in spread, but you won't be DSCR constrained and you'll be able to get the proceeds you want.
So let's kind of just bring this conversation home here and talk about kind of frankly the state of the market and where this all comes into play. The deals that had fixed rate debt that were taken out in 2021 and 2022 are not the problem childs of the market today, especially with a 5-year term on that. You probably have created enough value there, or hopefully there's enough tarmac there or enough going on where you have value inherently to the property due to the market kind of getting better in 2020. Call it 6 and 27. If you took out a 5-year term, 7-year term, during that time you've got a very healthy interest rate there. But the deals that are struggling the most right now are floating rate loans and bridge debt. So can you explain just very quickly to those who may be a little bit newer to the space in very simple terms why the bridge and floating rate debt deals right now are the ones who are suffering and are the losers in this kind of environment, but similarly why they were the winners when the market got really hot?
Yeah, that's so funny. The challenge that has happened in the market was quite simply floating rates rose at the fastest pace in history. And moreover than that, because that's not such a big deal, because the financial markets can handle a lot. What they can't handle is uncertainty and unexpected change, right? So if it's expected change, all of us could have handled the fastest rise in interest rates in history if we all expected it and all planned for it, and we all modeled out that into our numbers so that it was factored in and budgeted for. But what happened and what really hurts is when you expect something to do this and then this happened. So unfortunately, back in 2020, 2021, and 2022, the market there was a lot of inflation. So rents were growing very quickly. Asset values were growing very quickly. 80% of the world's money supply, or whatever the crazy statistic is, was printed in those couple years. So which all those dollars fled into assets. And so that's why we had an asset bubble, including real estate valuations. So it was a great time to be a buyer because asset values were going up so quickly. But what if you had done a 10-year fixed rate loan? Rates are really low back then. But if you'd have done a 10-year fixed rate loan, you'd have had a 9.5-year yield maintenance prepayment penalty schedule. And as assets were going up in value like crazy in short amount of time, 6 months, 12 months, 18 months, you wouldn't have been able to sell and maximize your value there. So that's why floating rate loans and bridge loans were so popular, because people were able to, especially on a bridge loan, put in a smaller amount of equity to acquire a large asset, and interest rates were low. So the floating rate loan was no big deal. And then the asset appreciated rapidly, and then you're able to quickly flip. It wasn't really real estate ownership or management or long-term wealth creation. It was, I don't want to say gambling, but it was just flipping. Like you were just buying a financial instrument and you boom, and then you were trading it out. It's not gambling because obviously it's more sophisticated and all that, but it's not that different. And so the problem that happened with all these gambles was everyone believed what the Fed was saying. And one thing that I've really learned in just this last few years is that you just really can't believe the Fed. You've got to read between the lines, and you've got to look at the history books. And what the Fed was saying in 2022 and 2021, they were saying, hey, this inflation that we're experiencing in this environment, it's transitory, it's going to pass, it's no big deal. We plan on keeping rates low and at accommodative level for 2-3 more years. So everyone thought we had 2-3 more years left until the music stopped. So everyone was playing musical chairs. Everyone was at the party, dancing, drinking, having fun, getting drunk. But guess what? On a dime, the Fed turned and announced, this inflation is not transitory. We are panicking. We're scared that we're going to get into a 1970s debacle where we're going to have sticky inflation, and that's the last thing we want. So we're going to raise rates at the fastest pace in history. And they rose rates from 0 to 5.3%. And that crushed everyone's numbers. There's not a single deal on the planet that had that predicted and that had that allowance and had enough cushion to be able to withstand that sort of rate change. So the music stopped abruptly and everyone was dancing, and there was not enough chairs for everyone.
Makes sense. Awesome. Any final thought on this subject?
Well, yes. The final thought is, it's very difficult for all of us not to be chastened, and I think it's good for us to be chastened, but for us not to now have a emotionally negative view on floating rate loans.
Yeah, recency bias.
Recency bias. That's exactly right. All of us saw what just happened and we go, oh my gosh, why would anyone do a floating rate loan? Look at what just happened. Everyone is losing their shirts because of floating rate debt. Floating rate loans are the villain.
Everyone but Neil Balwa would, hate on it, of course.
Right. Neil was like, everyone's an idiot for doing fixed rate, but that's a different strategy and that's a different topic.
And use my pref infusion.
But the point, I don't think I can't imagine he's done one deal, because like
with his Hope Note fund,
where's the distress, right? Where's the distress, and who, I don't know, whatever. It's a separate topic, but everyone
I have my thoughts.
Everyone wanted to grave dance and be like, oh, there's going to be all this distress. And while it's true, there's a lot of financially distressed borrowers and owners out there. It's not just so simple to go in there and make money off of other people's distress. Let's just put it that way. So anyway, my point about recency bias is, what I think is very difficult but smart is to understand that what we just went through was, like I keep saying now, the fastest rise in interest rates in history. So the likelihood of that happening again is very low. And we're at a high in terms of interest rates, on SOFR at least. I mean, treasuries, I think, are kind of around normal. I think treasuries are going to fall, whatever, and things are going to normalize. But the point is, I think from just a pure floating rate risk standpoint, I think today's a brilliant time to float. I think the only thing standing in your way from in terms of a floating rate loan is the sizing of it because of the agency guidelines and because of sentiment, right? Like try doing I'm going to do a 10-year loan, 10-year Freddie floater. And I'm going to go to my investors and I'm going to say, "Hey, let's go float for 10 years." Everyone's going to say no because we just had the crazy rise in interest rates and everyone's tired of not sleeping well at night, right? And so even though all the data supports floating and all the data says that, hey, if you float on any given timeline, even if it's, on average 2 years, 5 years, 10 years, it's going to be cheaper. And we'll have the flexibility to be able to exit when we want to. We'll make the most money in the long run if you float. Investors aren't going to go for that because we're not in the business of maximizing every single dollar and cent. I don't want to have to like wake up in the middle of the night and be all nervous and go through the ups and the downs. Like if the deal makes sense today, lock the rate, keep it simple. So I can kind of argue for both sides, but like Brad and I were having a conversation the other day. We were talking about, hey, if Brad and I were just billionaires and we were just investing our own capital and we didn't have to answer to any investors, we would be floating today.
Yeah, well, and that's actually kind of interesting. I have a thought. Well, actually, no. Let's go to that before I get into kind of my thought there. So let's talk about those three debt profiles: fixed, bridge, and floating. Can you lay out scenarios where you'd want to implement each one of the three?
Sure. So for us, we've been most active with 5-year fixed rate loans over the last couple of years because of the certainty of locking in the rate, right? Minimizing volatility throughout the hold period or the projected hold period, right? It makes your underwriting simpler. It's less variables for you and your investors to worry about. So I think if you have a value, like a light value add deal or a core plus deal in today's environment, I think a 5-year fixed rate loan is a great option. Not a 10-year fixed rate loan because I don't think rates are so attractive today that I'd want to marry it for 10 years, right? I'd rather date the loan for 5 years rather than marry it for 10. So that's kind of my thinking about a fixed rate loan. And then for floating rate loans, whether it be a bridge floater or a long-term floater, I think you really want to do that only when you anticipate a capital event in the near term. Like I would say within 2 years, like 2.5, pushing it maybe 3. Because even if you're thinking about a capital event in 3 years, I would still probably lean towards fixed because of the lower risk profile. And what I would do is maybe kind of split the baby and I would do a 5-year fixed rate loan, but then buy down the prepayment penalty. So pay a little higher interest rate so that I can still exit when I want to, pretty much, but I have the benefits of the fixed rate loan and it'll size better most likely than how terribly a Fannie or Freddie floater sizes given the no longer fixed rate equivalent guideline. So that's kind of the floating rate. It's a little bit of a tough situation right now to actually execute on those, even though like
Also to
logically
sell it
makes
to your
sense.
investors. Yeah, you got to sell it. At the end of the day, we're in the business of not, acting like we're so great, acting like we know everything and we're always making the best decision every single time. I think generally speaking, we do a very good job of it. That's why we make the big bucks. But making everyone sleep well at night and having them feel comfortable and excited about the deal and not emailing us consistently, calling us because they took a riskier profile and they just are losing a little bit of sleep or biting their nails over it is not really the model and the business that we're really trying to run here.
Yeah, that's a huge piece of it. So yeah, bridge loans are an interesting one because bridge loans are where you can take the most leverage, right? You can get a bridge loan 80% loan to cost, right? And if you have a big business plan where you've got a lot of renovation dollars in the deal, that can be over 100% loan to value, right? So bridge loans are where you go to take the most risk. So if you're looking to take a lot of risk, if you're looking to do a big transitional project, it does make a lot of sense to actually have your CapEx funded by the lender to do construction draws rather than have to raise all the money up front from your investors. Because if you raise equity for your CapEx, let's say you have a $5 million CapEx project on a $30 million deal, and if you raise that $5 million of equity up front, that $5 million is just going to weigh the returns down, because that's just diluting. You're using a lot of equity to do the deal. Whereas if you have that $5 million held back by the bridge lender, you're not going to be charged interest on those funds until you draw them. So let's say you do 100 grand, 200 grand of the work and then submit a draw request. The lender will fund that draw request, and now the loan will be funded an additional 200K, and now you'll owe interest on it. So it's nice. It's a more cost efficient way to actually do CapEx. Now, in practice, there's a lot of challenges with that, because draws can be a nightmare, and you got to do all this paperwork. So it's more asset management work to handle a construction draw process. So we try to avoid them if we can, but it's still definitely worth the headache. The other thing, though, is certainty, right? If I raise $5 million of equity, that's $5 million in the bank, and I've got that money to spend it on the CapEx if I need it. I can pivot. I can use it as reserves if I need it. I can give the money back to investors if I don't need it. But if the $5 million is sitting with the lender in a construction draw account, that's not my money. And the lender could wake up tomorrow and say, I think the economy's in a recession. I don't feel comfortable with this loan anymore. I'm not going to release these draw funds. And now the deal that was relying on that construction project to make the deal a success, you're not getting those money. You're not getting that fund. It's over with. So a lot of people had that happen to them in this recent cycle, because when interest rates went up and the market shifted and asset values went down, lenders were looking at these loans thinking, well, why the heck would I let the borrower take more money on already what is a bad loan? So they said, see you later. You're not getting any more money out of this loan. So now people are sitting on like bad deals with bad loans, and they don't have the money to do the renovations that they bought the deal to do the renovations on. So those are some of the pros and cons of a bridge loan. I think, especially as us sponsors, I think there's a lot of value to bridge loans. Like I said, you can buy bigger deals with less equity, and you can, hold back for all the construction stuff. But I'm gonna say something kind of controversial. I think if you're super rich, you don't use bridge loans.
Because you don't need to, accrue that much risk. You're saying essentially. I mean, I think someone was saying this. Like, listen, I think Patrick Bet David was talking about this once on his podcast, and he goes, if if you've already made your billions, you do not invest like this. If you're trying to make your billions, you invest like this. So it's a mindset kind of differentiator there, to your point. I guess bridge would also be interesting too, because for those who do or don't know this, if your occupancy is below a certain percentage and threshold, you will not be able to size up for agency financing for fixed rate or floating rate debt through Freddie and Fannie Mae. So the bridge, or a private money loan, is your route and medium to do that, and to kind of do that opportunity. So what situations come into play for deals like that in this marketplace? Really distressed deals where there's maybe really bad occupancy issues, or deals where there's just a heavy, deep lift and value add play to be had there. And then the other opportunity I'm thinking out loud about is if there is a merchant builder, there is a new construction property that is in a lease up process, or maybe is about to come online, but the developer might be over his skis, and you maybe need to take out a 3-year kind of bridge thing to lease that puppy up, because you're getting it for maybe below, basis, or some equity evaporation, or you really love the opportunity. Those are the instances where you would probably, logically speaking, and from a value perspective play, would be on the smarter end of the risk curve to kind of take out that bridge scenario, in my opinion, at least.
Yeah, you hit the nail on the head exactly. So I forgot to mention, the way that bridge loans can be incredibly valuable is when a deal simply does not qualify for permanent financing, particularly from the agencies. So if your occupancy is not at the 85, 90% level, agency is not an option for you unless you can work some Nate Lowy magic, right? And so the reality is, if you're buying a distressed deal that's 50% occupied, right, that's a perfect bridge loan scenario. The reason why I say if you're super, super rich, you're probably not going to do that, is because you might just go ahead and buy that deal cash then, right? Because you're not going to deal with the negative arb. You're not going to deal with the draw process. You're not going to deal with some headache lender or whatever. But that's like an extreme scenario. Going cash is a very extreme scenario, right? Everybody knows that real estate is bought on leverage, right? So you're probably not going to buy it cash, even if you're a billionaire. What you might do is you probably have some good, you for sure have some good banking relationships. So you go to like your private banker or whatever, and you say, hey, you know me, I'm good for it. I know this deal doesn't qualify. I'll sign a personal guarantee, whatever, but just give me like a
Recourse.
50, yeah, give me a 50, 60% loan, a loan to value, and make it recourse, make it real cheap because, I'm good for it, whatever. And then that's how they'll buy it. They'll just buy it with like a private money, but like a cheap private money thing. Key Bank is a similar kind of good example of this, where Key Bank has a program where it's like 20% recourse, and they won't go high leverage. It's like 70% leverage on a bridge loan, and the spreads are really tight, tightest spreads in the business. So it's like SOFR plus in the 200s. So that's kind of what I see as good bridge loan options. But today, like, I really just don't, unless you've got super unicorn unique scenarios like what we had this year, wink wink. I just really don't see the opportunity for bridge loans in 2024. Maybe in 2025. Like you brought up the merchant developer scenario. Like right now, I think is a great time to buy deals that are in lease up. So the developer is just finishing up the deal. It's like 10, 20, 30, 40% leased,
He's
and they
probably
just want out of it.
emotional. He's probably really distressed, probably losing some hair and going gray, ready to get the frick out of that opportunity.
Right. And, you know, it's a 2024 vintage deal. So it's not like a value add deal. So it's not going to be able to support a 9% bridge loan. So you can't really finance it with a bridge loan. Agencies won't give you perm debt for it. So how do you buy those deals, right? Well, cash would be one amazing way to go. Like if you could buy a deal that's literally just constructed in 2024 and you could buy it 10, 20% below replacement cost, all cash, that's like in its core product, you know, that's like buying treasuries, but you're getting a better starting yield and way more upside and tax benefits. So it really does make sense to buy cash, but just nobody has 50, 100, 150 million cash sitting around. So obviously you need some form of friendly leverage, I'd say.
Right, right. Well, very interesting stuff there. And I kind of have another note to think about as we kind of talk through this, which is you mentioned like where's the distress? Where is it, right? Very interesting to think about how I guess maybe call it resilient. Obviously, there's a lot of spending that's been going on in the government, but you mentioned a figure, and we talked about this offline and personally, just how sad it is, but how 80% of the money supply and the U.S. currency was printed over the last half a decade, basically since COVID, which is a sickening thing to think about because that really hurts, frankly, the common worker, the common person, the average day-to-day guy, if you will, day-to-day guy or gal. But that said, really brutal. But my take to that is, well, asset prices are going to soar once this market is corrected. Rest assured, that money is out there floating here and there. I think assets are, with that said, all that money going on, prices are about to explode. So to kind of beat the inflationary environment, to hedge against it, you need to have your dollars not in the bank, but into, assets, into the stock market, hard assets, things ideally that the Fed can't print. The Fed can't print, precious materials. They can't print, more land, and they can't, build multifamily workforce housing below replacement costs. So those are some ideas as to kind of hedge against inflation during times like this, of course. So I cannot recommend you enough to look into our assets, look into kind of our structuring and whatnot, because I do think when the market does get corrected, due to the fact that there's not as much distress as people think there was going to be, buckle up, because what you see price per unit today will not be price per unit for tomorrow, particularly when you consider everything going on right now.
Yeah, I don't think we're going to see rents go down much, if at all. So I just don't see values going down as well. I do think, however,
Particularly when
this.
rates are going to get cut too.
Well, yeah, that's exactly right. That's the gravity or the buoy to values, and then the thing that would be gravity that would push values down would be rents going down. And I just don't think multifamily is going to see a drop off in demand big enough to really have a material impact to values. So yeah, I do think that that's where real estate is. The stock market, though, is a very interesting puzzle because we're hitting all-time highs, and it's actually very common for the stock market to hit all-time highs once the cutting cycle begins, and then once we're in recession. So it's funny how usually it doesn't really make sense, but the stock market actually makes highs once we're like in the recession. And that's interesting to me because I wonder and actually believe that the stock market right now is not pricing in correctly earnings. I think the stock market is overvaluing earnings. So I think the stock market right now is trading higher because of the cutting rates and the anticipation for lower rates in the future, because stocks are obviously traded based on a discount rate, which is the 10-year U.S. Treasury yield. So people are anticipating the 10-year U.S. Treasury yield to go down. I mean, the 10-year U.S. 10-year swap rates are 3.2%. So, I mean, basically, I think the 10-year is going to 3%. So a lot of people also think that, and so they're going to be pricing their stocks based on a 3% 10-year. However, what I think they're forgetting is that I think the earnings that they're using to create those stock valuations are going to go down also. So I think we're going to see a little bit of that happen in the market. I don't think that. I'm a bit conflicted because I think obviously real estate and stocks are correlated, but I do think that obviously this is talking their own book, but I do think stocks are going to be lower 12 months from now, but I think real estate will be higher 12 months from now.
Yeah, and it was ironic. I definitely think that if you are a 2022 and 2023 investor, 2021, yeah, well, stock market was the play considering where it is right now. But, these things go back and forth, pendulum swings. It's the type of investor you are. Everyone has different wants and needs. But with that said, we've had a great show here today. We have a lot of topics ready for you next week that we didn't get to. So we're excited for that. For all those who are listening, we appreciate it. Once more, if you're looking to get a touch and a look into the deal flow, what we're up to, what we're doing, email me, Craig at lscre.com. Thank you so much, Rob, for your time today. And we'll see you both all next week.